What is wrong with our biotech index? Our biotech index, I think it's an understatement to call it a debacle. We're in the fourth month of the year and we are down over 50% on average in our biotech index for the year. We started with a 20% position, so we lost 10% to the portfolio through our CRISPR index. 5 stocks, Intellia, Beam, Caribou, Twist, and PacBio. Those are the 5 stocks that we own in that index. The index is, we call it the CRISPR index, but it's certainly not just CRISPR. Let's call it digitization of life sciences. This is how we described this in the past. So it has been a debacle. I think there's no other way to discuss it. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. Well, this is one of the most unhappy things to do, which is discuss the bad children in your portfolio. That's what we're going to do today. This is not even on podcast. It's April 23rd, 2022. This is Crimtelco. It's a Saturday. There's no update. So for the year, we're down 15%. The market's down 10.5%. We're underperforming by 4.5%. Our biotech index has been pretty good since inception, which is early 2021. That's when early 2020. That's when we incepted. So we've been in this for more than 2 years. At this point, we have lost money, cash on cash, with our investments in several biotech. We didn't start with the 5 stocks that I just named. For example, we had CRISPR, we had Illumina, we had other stocks, but then we sold and sort of focused on this because the purpose of Orange Capital Partners is to generate wealth by investing in fundamental new concepts and engineering practices. So we really focused on fundamentally new concepts and engineering practices. And this is actually where I want to start with my conversation. Because when we evaluate a disaster like this, and I'm using the word disaster simply because there's no other way to describe a drawdown like this, in a 20% position, you're down 50% in the first 4 months of the year. This is no other word, and it is unfortunate. I've said many times, volatility is part of the business. It is that business, not just part of the business. So we have to focus on that. And the key question is, okay, am I holding on to this? Am I basically investing in a zombie here, or is this just a market gyration? I mean, there's a lot of macro reasons why this is happening. Interest rates are up, risk assets are being sold off. Many other companies, software service companies, Netflix, Facebook even, all of them are down this much. So this is not just our biotech index. So it's easy to throw this in a basket of, well, all risk stocks are down, but we're fine, we're just going to stick with this. No, we don't want to do that. I think, like I said in the prelude, we want to give people a sense of what it feels like to run a hedge fund, and you have to look the devil in the eye here. You have to ask yourself, did I make a mistake? What's going on? This is not what I wanted. I've been invested for 2 years in something so exciting like CRISPR, and I'm not getting any results. Maybe I'm wrong. So let's talk about this fundamentally. Fundamentally new concepts, engineering practices. This is the first thing I want to talk about here because this is key. Okay, are these stocks fundamentally new concepts and engineering practices? And what I mean with that is there's a lot of companies out there that do new things, but doing new things doesn't mean you're a fundamental new concepts and engineering practice. Best example is Netflix. It's my go-to example. Like I said many times, Netflix is the gold standard of companies that fail. What I mean with that is it's a positive way to say that they failed, in my view. They made mistakes, and they are not a disruptive company. However, they are a great company. So nevertheless, they probably lost money to a lot of people. They made money for some people, but they certainly lost money to a lot of people because they were perceived as a disruptive company when they weren't. And I think I want to start here and contrast Netflix with, let's say, Twist Bioscience or PacBio or Intellia. When I talk about the index, they're very different companies, but I think there are certain commonalities, and those are the things that I want to point out here. So the problem with Netflix is it's not a disruptive company, because what Netflix was trying to do is change Hollywood. Well, guess what? Hollywood is changing Netflix, and a former tech company actually turned into a media company and is receiving a media valuation. This is, in general, what's happening. So if we use this analogy now to our biotech stocks, then we could say, well, the biotech stocks are trying to change life sciences, and well, guess what? Life sciences is changing them. They're just becoming another life science company with a certain valuation that those companies have. Is this happening or not? And the answer is no, it's not happening, because these companies are all about the science. They're all about the science, about engineering, about applying these fundamental new concepts, engineering practices to the life sciences. So they're not spending billions on content like Netflix, which is or another. What I'm trying to say is, when we discuss the question, is company A really disruptive, or are they just something new, and the competition will catch up? Then let's just look at what they actually do, and if what they do on a daily basis is very similar to what the competition is doing, then there's a risk competition will catch up. In the case of Netflix, a lot of the conversation Netflix was about content, was about hiring producers and actors and writers and directors, and that's something that Hollywood does too, and actually Hollywood probably does even better than Netflix. So in that sense, Netflix became a media company. Also, I missed, let's say, conversations about technology, about, like I said, for example, why didn't Netflix focus on AI and become the best recommendation engine for media assets, period, not just their own library. So those would have been the things that I would have liked to see Netflix do. Now let's look at about our CRISPR index. So the fundamental new concept in all of these is, of course, it's either genomic sequencing, it is DNA, it is synthetic DNA and the application of synthetic DNA to life sciences, like in the case of Twist, or it is the application of CRISPR technology and base editing to medicine. And those are fundamentally new concepts that nobody else is doing. So this is, first and foremost, they spend their day fundamentally doing things that the others even, they can't do. And this already puts, of course, a value on these companies, because even if they fail, they still have the IP, the know-how of doing this, which in our view is the future of life sciences. So this is good news. What's not so good is, of course, the fact that a lot of what they do is also what the others do, let's say getting FDA approvals and all that stuff. So in that sense, of course, they're very similar, but that's the nature of the business. There's just not much you can do. If you want to create medicines, you have to get FDA approvals, very similar to Tesla that has to get, let's say, NHTSA approvals for cars and things like that. So there are things that they do that others do, but a lot of the stuff that they do is very unique. And this is giving us the confidence that our CRISPR companies are actually unique companies, that they are disruptive companies. Why are they disruptive? Because they're using a new technology, a new science, a new fundamental new concept, an engineering practice to change an industry, and hopefully can lower the cost and increase the value by 10x. This is fundamentally what we're trying to achieve here, and that's also something that Netflix hasn't done. They really haven't increased the value dramatically and lowered the cost. They did increase the value to some extent, of course, but it's just becoming very difficult to differentiate between the streaming service of a Netflix and the streaming service of an Apple or an Amazon. Now let's talk a little bit about the actual stocks and the valuations. Now, I would say that the key problem with almost all of our biotech stocks is valuation. Because if you have these companies just isolated, you can say, look, they sit on cash, what they're doing is incredibly useful, so they're fine. The problem is they're priced very high. Pact Bioscience, for example, has 130 million in revenue and 1.6 billion in market cap. So more than 10 times revenue when they're spending more money on R&D than they have revenue. So those are concerning factors. And like with many growth stocks, you could say, well, that's a bad thing or a good thing. Depends. I think time will tell. I think with Pact Bio, we have to see how it evolves. One of the metrics that we're looking at with Pact Bio is that if this company keeps growing revenue, let's say by 30 to 50%, we expect that sales and marketing and R&D don't grow at the same clip. If we see operating leverage in the business the same way we saw it in Tesla, then we would be confident. If not, we would have to get out, because then the business is just not viable. So this would be one of the metrics that we look at for all the companies. Again, I use Pact Bio as an example, but we can apply that to all the other companies as well. Talking about Intellia has proven last year proof of concept of a therapeutic, of an in vivo therapeutic using CRISPR. The stock went from 50 to 200 within weeks. Now it's back to 50. We would say that that alone should be enough safety, of margin of safety for us. They have proven that they can do something, and assuming that the data keeps coming in on a positive clip, we think that the stock should be able to continue doing well, if not through monetization of the technology, then through acquisition of the know-how. So to summarize, the debacle in biotech that we are facing right now, in our view, is driven primarily by the technicalities in the market, the interest rates, the fact that Cathie Wood has been a big proponent and she's being cornered by the market, the fact that liquidity is very thin in those stocks, the fact that they are very, very highly valued and relatively, with an interest rate environment that we're facing right now, that is unfortunately not a good thing. We also had some bad news with Ginkgo Bioscience, which is involved in the synthetic biospace. There were accusations of fraud and things like that. The stock is down 70% from its IPO. So a lot of negative news, a lot of negative sentiment. We stick with our index because we believe that the know-how and the actual work that's being done is fundamentally new, and that the new engineering practices can transform life sciences from a bespoke field into a more engineering, digital-driven field. This was the ultimate goal of our CRISPR index, and we still believe that that is going to happen. We expect to make money with this investment in 5x in 5 years. That was the expectation. We're now 2 years into the investment and we're down, so we still have a lot of work to do. We believe that data, fundamental, the two vectors that can drive valuations back to where we believe, or the stocks back to in a positive territory, are: one is fundamental news on the business front, good news either through demand or product success or medical success, and if that doesn't happen, then M&A. Those are the two vectors. M&A being the biopharma industry is sitting on hundreds of billions of cash. The investment community is happy to invest in product growth. Growth is the main scarce resource in the pharmaceutical industry. But apart from that, we have just look at this more on a sort of natural Sharpe ratio point, from a natural Sharpe ratio point of view. So forget the financial markets, forget interest rates, Cathie Wood, cornering, shorting, forget all of that. Let's just talk what is happening in the real world. We have medical problems, people are getting sick, we have agricultural issues, crop growth, things like that. We have animal problems, animal health, and also food supply, and all that stuff. All of these things, let's just bundle it up into life sciences. And now we have an approach which says some of the issues, some of the problems that we're trying to solve in the core are either monogenetic or polygenetic, which just means it's either one gene that is causing the problem or several genes. We're at the beginning of trying to understand what is mono, what is poly, how this interaction and all that stuff works. We're also, we have this doctrine in biotech, which is DNA, RNA, protein. We have made a lot of progress in protein folding technology thanks to AlphaFold. So there are a few developments. We obviously have the CRISPR technology, we have Beam Therapeutics, we have prime editing. So we have ways to write the genome, to delete the genome, to edit the genome. That, coupled with the genome sequencing technology that we have, thanks to PacBio and Illumina, helps us read what's out there, change it, see what happens when we change it. This is the fundamental flywheel of research, and this is why we're investing in this space. This is why we believe that we are at the beginning of a change like the transistor was of the 20th century. CRISPR to the 21st century is what the transistor was to the 20th. A fundamentally new way of doing life sciences, the same way the transistor was a fundamentally new way of doing computation, and then we applied that to things like telecommunication, and then later on to computers and so on and so forth. This is why we're so excited about this. And we also spoke about probabilistic stuff. in one of the past episodes. So we don't want to talk about probabilities here. Well, the probability that Intellia will succeed is 70%. There's no such thing. It either will succeed or not. That's it. And the reason we believe it will succeed is because of all the things we just said. There are monogenetic diseases and polygenetic diseases, and we have a way, a low-cost way to do research about these things and figure out what's going on. And this is the fundamental progress that we're looking for here at Orange Capital Partners that we believe will have large impact. Now, how is this going to translate into monetization? Well, there's two ways this can go. Typically, when we analyze a situation like that, we will say, look, the healthcare industry in general is trillions of dollars globally. The life sciences industry is saying trillions of dollars. So it is not crazy to think that this new way of doing things can at least become that large. And actually, typically, when we have new innovations like that, then the market grows faster. The same way if we had looked at the market of computation in the 1950s, we would have said, I don't know, it's X amount of dollars, and now we have the introduction of the transistor, and it's going to be, no, I mean, obviously the market became many times more bigger because with these new technologies and new, better, low-cost ways of doing things, you also get much better at doing stuff and figuring out things and create demand and solve problems, create problems, build innovation stacks. And actually, now that I just said that word, of course, I have to say that what we believe this whole CRISPR technology and sequencing and synthetic biotechnology will bring is the beginning of a new innovation stack with multiple $100 billions of value. This is one way this can go. It can go also the other way. We've been there before. We've seen, let's say, innovations in, for example, electrical grid technology, digitizing the electrical grid, where we thought, well, that's also a multi-$100 billion industry, and if we can digitize and make it more efficient, then it can become much better. And it didn't pan out because the OEMs, the incumbents, just didn't want to do anything new. The solution to these types of problems would be what Tesla did, which is instead of building an electric car and selling the technology to the OEMs, you just become a car company yourself and do what Tesla did. So what I'm trying to say is it is not a foregone conclusion. It is not a probability of one type event that all of this innovation stack will actually happen, but it is close to one. And that's why we're invested. Thank you.